everybody. Today I'm going to do this video on inflation is already here based on an article out of the Wall Street Journal. So we're beginning to see inflation impact some of the inflation numbers that the government's putting out. First the CPI and the PCE, which is slightly different and used by the Federal Reserve. We definitely got a rebound from the coronavirus dip in inflation, and this article is a great article. It goes into what's really driving that, and what prices are actually going up and what prices are down. Some of this will be somewhat obvious, but the article actually touches on something which is really interesting. Is that there's obviously a demand component to consumer prices, but the supply component, which I think in this crisis we really got that effect coming through, just because we've seen companies like hotels, many hotels are shutting down, many airline routes have been shut down. They're approximating like 50 to 60% of hotels across the country might be shut down permanently because, well, there's just not enough people booking their rooms, and for airlines it may be very similar. So what that naturally drives is the fact that, well, demand tends to recover much faster than supply. Where's supply come from? It comes from real businesses that may not exist anymore because of the long and drawn out shutdowns. So where are we seeing prices go up? I think this is really quite interesting and somewhat intuitive as people are staying home. Interestingly, healthcare up 5.3%, bicycles almost 6% at 5.7%, and food at home. So this will be things that you buy at the grocery store, which I think all of us we're beginning to see 4.6. These are really quite high numbers. And on the flip side, where are things getting cheaper? Well, I mentioned airlines. Airlines is down 23%. I mean, it's huge because no one's traveling. Hotels 13.1, city transport, so public transport, and taxis down 9%. So, I mean, if we think about it, these are all run by businesses which may not survive or may go out of business voluntarily. So I think we're setting up for a large inflation spike when demand does recover. Now, that really depends. We don't know when that's going to happen. I mean, it may be happening right now, or it might take a year, but we know demand's going to come back at some stage. But businesses will not be able to reopen and as quickly. As many of them might be out of business. So, we already have a spike in inflation for the things that we really need at the moment: food, healthcare, cable and TV. Those things people have at home and use at home because everyone's working from home, and things at the moment we don't really use. But then in the future there'll be less of to use, and demand will come back faster. Will adapt faster. So it really does look like we're setting up for a spike in inflation, into next year. We could easily see that happen. Interestingly, we've seen a divergence between the CPI and the PCE. The PCE is the one that the Fed uses, and the difference is that consumer prices is generally based on a basket of goods, but the PCE is based on what people are actually spending their money on now at the moment. So I just want to show you this. The Fed said, well, 2% is usually their line in the sand, but they'll probably go above that. So if we look at the PCE right here, in August it printed 1.4, up from 0.9 in June, and accelerating. So the question here is that if this keeps going, we could easily hit 2% inflation on the PCE, the number the Fed uses. And that's really something to be watching. So something to keep in mind is, well, how would you, as an investor, hedge yourself for a potential rise in inflation due to disruptions in supply, driven by companies going out of business, the trade war. But China, I think there's going to be a permanent shift in supply, and inflation picks up. And there's a feedback loop, which I don't think anyone's really touched on just yet. Is as inflation rises, long-term interest rates rise. That means basically it costs more for businesses to borrow to do business. So the hurdle rate's higher. So meaning that you actually have to make more money to just service your debt. So what ends up happening is prices rise once again. So there's a feedback loop with inflation and supply, where inflation rises, interest rates rise, supply is lower than it would have been if interest rates were lower, because the hurdle rate for being profitable just got higher. So it sort of feeds on itself until you have a peak and it extinguishes itself. But that can take years, and it can be extremely sharp. So the question is, how do you hedge yourself? The thing is, if you don't have a very well thought out asset allocation in your investment portfolio, you're really not going to do well. I mean, stocks may not do that well. They may just tread water and be extremely volatile, because there's just not going to be that much growth, and inflation may rise. But at the same time, bonds are going to get hit really bad, right? So if inflation does pick up like it did in the late 70s and early 80s, bond prices can go down 20-30%. Most people don't realize it, and especially for retirees, that's a major hit, and especially when you have almost a zero yield. So without things like precious metals, you're not going to fare well. And also, I would say, some exposure to real estate, because they are able to adapt to inflation, because rents generally rise in an inflationary environment. But real estate prices may fall in that situation too. But we're talking about commercial here, and you should be doing reasonably okay. So yeah, please check out our website. We build portfolios at Analog Capital Partners with stocks, bonds, real estate, and precious metals, which is a combination of assets you should also own, but always own, but you should definitely be thinking about it right now, because the setup is there for rising inflation, and there's very little ownership of precious metals by investors. It's the perfect time to get in. I think the market has been appreciating this, and they, gold and silver have done well this year. Have beat stocks and bonds hands down. So it's not too late, and check out our website and potentially open an account. Thank you.